Your money, your business. This is Financial Poise Radio, the spoken word sister of FinancialPoise.com.
Hello, everyone, and welcome to Financial Poise Radio. I am Christopher Cahill, your host. In a few minutes, we'll be talking with Alexey Sokolin. The last time we spoke with Alexey, he's been on this program before, he was a thought leader regarding robo-investing. Alexey is now with Autonomous Research, a company on the East Coast, and is a thought leader in big data, AI, and blockchain, among other things. So regarding big data and blockchain, I myself was at a conference recently hosted by HPD Software of the UK. And HPD Software creates software specifically for trade finance and risk management. And they are, of course, integrating elements of AI and big data into their software, not blockchain yet. But it struck me that blockchain would be very useful for trade finance and for supply chains generally. I know that sounds awfully abstract, but the key here is that blockchain is a distributed ledger, as we will discuss later, on which multiple parties, say a purchaser, a seller, and the lender to the purchaser to help the purchaser have the money in order to buy from the seller. Let's say they're all on the blockchain at the same time. And let's say that data feeds have been created among all these parties so that everybody knows when the seller ships. Everybody knows how much the seller is shipping and what the seller is shipping to the purchaser. Meanwhile, the lender knows what the purchaser is buying and how much it's going to be, and the lender also knows where the things being shipped are, because that's inventory on which the lender has a security interest. If the lender doesn't get paid, it gets to take those items and sell them. And so it's always of interest to the lender to know where the collateral is and what its condition is in. Well, again, if you put the right kind of data feeds, including right on the widgets themselves, larger things that people buy and sell these days, like cranes that are used on construction projects, large construction projects, are likely to be outfitted with GPS engineering so that a lender knows exactly where the cranes are. The owner knows exactly where the cranes are at any given time. Well, imagine a world in which we have that kind of technology for any size widget, and you're beginning to understand what can be accomplished here with something like blockchain. So now the lender knows just how much inventory the purchaser has to whom the lender has lent a substantial amount of money. The supplier knows where the stuff is. The purchaser knows where the stuff is. Now the purchaser pays the supplier, and the lender knows that. He knows what kind of liquidity the purchaser has. The supplier knows it's getting paid. Meanwhile, the lender might also take a security interest in the accounts receivable of the purchaser and borrower. So now the purchaser sells it to its customers, and everybody involved knows when the customer is paid, how quickly they paid. Thus, lender and borrower are aware of the condition of borrower. Borrower knows that the lender is aware of the condition of borrower. And then we won't have what we in the insolvency trade, and I am a corporate bankruptcy lawyer in my other life, we don't have what is called the river of denial. Everybody knows when the borrower is in less than great shape and can do something about it faster before the river of denial sweeps away all value. So blockchain in that kind of relationship can bring great efficiency. If a lender has greater knowledge of where the collateral is, the lender can lend a little bit more money and on better terms, especially if the buyer's performance warrants it. Meanwhile, everybody involved knows what everybody is doing in real time. Again, this is a model of economic efficiency. Of course, that's an abstraction in the air. Let's see what happens in real life, what kinds of unintended consequences blockchain will bring in this situation. I guess the future ought to be interesting in the supply chain and supply chain finance area. Okay, going from abstraction to something a little bit more palpable. Pumped storage. I love this idea. We have empty coal mines, or we will, as coal becomes more and more disfavored either through the regulatory apparatus or simply by being outcompeted as a source of energy by natural gas via fracking and so forth. So let's say we're switching away from coal and we have empty coal mines. Meanwhile, at the same time, we're becoming more reliant upon solar and wind power. A big knock on solar and wind power is that they're not constant. The sun stops shining at night, the skies may be overcast, and the amount of power in the grid will be thereby lessened. Similarly, when the wind stops blowing, the amount of power from wind in the grid is lessened. How to keep the grid in a more stable condition as far as how much power is coursing through it so that we can conduct our lives and businesses? Well, it's a very simple technology that involves turning coal caverns, say 2,000 feet below the surface, into underground reservoirs of water. All right. Put a bunch of water inside the coal cavern, then run a pipe to the surface where you've built a similarly sized surface reservoir. So when the wind power and sun power are generating too much electricity for the grid, use that power, that excess power that you're not going to sell anyway, and use it to pump the water from the reservoir deep in the mine into the surface reservoir where it sits. And when the sun stops shining or the sky is overcast, and it's also a windless day to boot, so that the electrical grid needs more power now, well, open the sluices, send the water from the surface reservoir down to the cavern 2,000 feet below via gravity. And as the water falls, have that water turn a turbine, as you do in any hydroelectric project. That turbine thus supplying, when the energy grid needs power, extra power. And when the water has descended into the cavern, when there is a surfeit of power in the energy grid, you use that surfeit to bring the water back up to the surface. I love it. I think it's a great low-tech way in which to balance out wind and solar and use underused caverns as we abandon coal, if we abandon coal. Well, that looks good, but according to the Wall Street Journal article dated May 26, 2017 by Zeke Turner, a very good article, as I have indicated. I'm really taken with the low-tech approach to a high-tech issue. This would work better if energy prices were higher. Believe it or not, we live in an era of low energy prices due in large part to fracking and the immense amounts of natural gas that fracking liberates, which causes natural gas prices to lower, which allows those who wish to convert to natural gas to do so, which exerts downward pressure on all energy prices. So if energy prices were higher, it might be more economically feasible to do the pumped storage idea that I like so much. Well, that is not big data, that is not blockchain. So I'm going to send you back into the precincts of big data, blockchain, and artificial intelligence as we talk to our guest this week. Alexey Sokolin is a partner and global director, Fintech Strategy, for Autonomous Research. Now, Autonomous Research produces in-depth, unbiased investment research on global banks, brokers, asset managers, insurance, investment services, etc. And for more information, go to www.autonomous.com. I mention that for the information, but also because I'm deeply impressed that the company got the word autonomous to be their URL. Previously, Lex was Chief Operating Officer and founder of wealth management platform Vanare and founder of robo-advisor Nest Egg Wealth. And it was about those two entities Lex spoke on our show before, so you can go back and listen to that if you'd like. Lex jumped into financial technology entrepreneurship after getting a JD MBA from Columbia University. What we have here is a Wunderkind. Lex, welcome again to Financial Poise Radio.
Thanks for having me. It's great to be back.
All right. So you've joined with autonomous research. Let me paraphrase from a press release to set up our topic for today. The press release says, we are experiencing profound transformation at every level of value in finance. And it poses three levels: the infrastructure, the middle office, and client experience. At the infrastructure level, Bitcoin and blockchain are transforming value in finance. At the middle office level, there's artificial intelligence and big data, and client experience, there's robo-advice, wearables, virtual reality. Incumbents are being challenged on all these fronts by unfamiliar competition. Not all will keep up. The industry is having a blockbuster Netflix moment, and financiers need rapidly to develop expertise in what Silicon Valley plans to do next. All right, before we start talking about blockchain, are we really talking about Silicon Valley itself, or does Silicon Alley have something to do with this, or other sources of innovation?
That's a good framing. What's really happening in the industry is this tectonic collision of media, technology, finance all at once. Whereas in the past, there were a set of activities that financial companies did, whether it was wealth management with my previous company, or whether it's banks or analysis, and then separately things that media companies did, communication, social networking, things like that. Today, those elements are all coming together into one very tumultuous ecosystem. And so I just use Silicon Valley as a shorthand, but what we really mean is the entire fintech sector, which has been born from this change in the industry of people thinking about innovation, of thinking about using the consumer web and the mobile web to create new kinds of companies that look very different from the legacy incumbents. One of the interesting examples is something like Snapcash, which is the ability for somebody to make a payment using Snapchat. Is that a media company? Is that a financial company? I don't know. Or for example, I think yesterday, Apple announced that you can text somebody money, and Facebook Messenger can now have chat bots where you can interact with them and move money through a texting interface. So that's really at the heart of what we're talking about. It's that weird innovation and transformation of finance into financial technology as it is today.
My, I was just thinking that I might start using my phone to take pictures of my checks to deposit them. I guess I'm about 4 years behind the times. But let's talk about blockchain, which autonomous research identifies as being part of the infrastructure, as distinct from client experience and middle office. Many are excited by it. There are some who sneer at it. I recently witnessed a sneering at blockchain from a presenter discussing Brexit and the future of EU and UK economies from one of the very largest banks. Yes, there's a lot of enthusiasm. Maybe not all of it is merited. But let's talk about what it is. Lex, what is blockchain?
What a question. Well, blockchain is really a fundamental technology. It's a core technology, and today it's in the state of research and development. So if you were to draw an analogy to medicine, we've just discovered either an instrument that will allow us to get to the next stage, or perhaps a molecule or a DNA strand that we didn't understand before. So that's where blockchain is. Historically, the blockchain ledger came from Bitcoin. Bitcoin, of course, is the most infamous cryptocurrency. It's completely public. It's impossible to eradicate or regulate or really control in any way. And the way that Bitcoin has been able to do this, to be digital and to be public, is through a mechanism called the blockchain. It's literally the digital ledger on which Bitcoin sits and moves around, and it's the mechanism by which you know that a transaction is real or not. And so the innovation that blockchain brought is that trust can be decentralized. You don't need a central bank to say, this is real currency, and you don't need a industry bank or an asset management firm or a custodian to say, we're holding your assets, they're real. Blockchain is literally the mathematical technology that allows for a Bitcoin to exist and to be trusted in a transaction. And so the industry figured out that they can actually separate this part from Bitcoin and from the cryptocurrency and try and build not public ledgers, but private ledgers. Think of industry consortiums like SWIFT that comprise all the participants and then do a whole set of kind of important industry functions like settlement or money movement, and later down the road, of course, transactions and trading. And so what we see now is essentially across the universe of financial services, from consortiums of investment banks to consortiums of credit unions to stock exchanges in Australia and in Japan to central banks in China, thinking about how can we use blockchain in what we do today. And the use cases are quite different in each one of those different universes.
Well, let's get down to basics so that we don't get swept away with enthusiasm, or at least don't sound like it. What's the block? What's the chain? And it's been called a distributed ledger, which has a lot to do, I think, with the trust dimension. So what's the block? What's the chain? And what does it mean for it to be a distributed ledger as opposed to what else we might be using?
Sure. So without getting too far into the math and getting beyond probably both our pay grades, end of the day, you can think of it as a database that's everywhere. So historically, a database would store a whole set of information, right? Think about a server. It's a single computer from which you would download a file, right? Or if you go to a bank and you try to withdraw money, you know that the money is at a particular institution. So there's a centralized ownership of the currency of the asset, and it sits in one place. Bitcoin, which is the original blockchain, which uses the original implementation of the blockchain, is almost entirely opposite. It's a peer-to-peer network, and what that means is that it's a ledger where this database is shared with all of the different people that use Bitcoin. So if there's 1 million people using it, you may have 1 million versions of the same ledger on all the different computers. And so what that allows you to do is to have trust without any particular point of failure. It's the network itself that validates whether a transaction is real or not. And it does so through pretty complex math. It will encrypt every transaction using a hash function, and it will validate whether the hash functions are correct. And so there's a lot in the design of the ledger itself that allows it to have this essentially kind of magic quality, this property that the network itself can validate whether something is real or not. But that's not the only way to design a blockchain. You can have a distributed ledger that's not public, but is instead private. And so what that means is instead of having everybody control or everybody participate in deciding whether transactions are real or not, you can have a few select institutions that have that control. And essentially, they would have a stake in the system that's different from other participants, and based on that, they could create a consortium which is semi-centralized, which would give power to certain institutions, and then they would be able to validate and control. And so that feels a lot more aligned with how our financial services industry is actually structured, which is why you see firms like the investment banks and consortiums like R3 get really excited about creating these private versions of the blockchain.
Not to get off the topic, but I couldn't help thinking about dark pools, which are run by large financial institutions to allow trading within a forum within that institution, which is distinct from any of the big trading functions we have out there, like the New York Stock Exchange and so on. Is that something where a private distributed ledger might be important?
I think there are applications to dark pools. There is a feature of the network which can be built, which is anonymity. So if you want all of the participants on a network to be anonymous, you can give them that quality. So it becomes much easier for trading to happen without somebody trying to front run you or get information about who sold any specific security. There are challenges to trading on the blockchain. I think it's actually one of the use cases that will come after maybe settlement or reconciliation, which are near term. And the main reason is that trading, the blockchain is not necessarily optimized for trading. It's very good for things like solving the trust issue and for organizing data in a way that everybody has access to, but it's not as good at being fast and scaling to be very big. Those are still challenges. So I think it's feasible, but maybe not one of the first things that happen.
Okay, that's interesting. There's going to be an evolution, and we can have some notion about how that evolution will take place. I mean, from what thing to what thing. But let's talk to where blockchain is going to be imposed in an area that is really interesting to me as an attorney and as a former political scientist. And that is in land registries outside of what we used to call the first world. So land registries in places where property rights were not as cut and dried as they are in the United States and the UK and France and places like that. And there's a very exciting project actually taking place in the Republic of Georgia, former Soviet vassal state, where they didn't have a tradition of straight up trustworthy land registries. And throughout what we used to call the third world, land registries have been corrupt. They've been a tool of the powerful to oppress the weak. And to the extent they were unreliable, according to some economists, the weak were unable to avail themselves of the benefits of having clear title in anything. And those benefits are outlined in a book, which I recommend to everybody, called The Mystery of Capital: Why Capitalism Triumphs in the West and Fails Everywhere Else, by Hernando de Soto, a great Peruvian economist. 2000 is the year of publication, but it's just as relevant today as it was then. And Mr. de Soto is involved with the project in Georgia. So how might blockchain solve the problem of creating clear title where there wasn't clear title before across an entire system of property records?
It's an ambitious project for sure, and a very interesting one. And I mean, it can change fundamentally the entire economic setup of the country. So I'm glad you brought this to my attention because it's a really interesting question. At the core, the issue is, as you said, trust, fraud, corruption. So if we think of blockchain as a mechanism or as a technology to solve the issue of identity and trust, and what that really means is you can't change history. If there's a ledger, right, if there's just a set of entries going back into the past, that will show title as it was, or as it were starting with the implementation of the system. It's just extremely difficult to impact that ledger or roll it back or change any entry. And so this is useful in situations like digital currency where you don't have a bank, right? And that's why Bitcoin got the adoption that it got. The other interesting thing, and I'll just bring it up again about Bitcoin, is that many of its original users have a strong sort of anarchist streak where they don't trust existing institutions, whether they're financial institutions or central banks or governments. And in the Western world, that may seem like an exception. That may seem like counterculture. But in the third world, where you do have governments that are corrupt, where you have revolutions, where you don't have systems in the country already developed, where you don't trust the legal or the economic system, Bitcoin is a great way to save. It's a way to preserve value where you don't have another way to preserve value. And so it's really interesting to see a situation where a government has enough self-awareness to say, listen, we know that you can't trust us. We know that we don't have the track record of credibility potentially for investment to flow into our country, for folks to buy real estate, to transact in real estate, to live comfortably and safely in the land that they own or in the real estate that they own. And so blockchain then has this promise of keeping everybody honest, right? Meaning this particular piece of land, it exists and it is real and it has this address and this is the list of owners over time, and it's very difficult to impact or change.
And the argument that DeSoto makes in his book is that there are many countries which liberalized, and that's in the sense of making them more capitalistic, their legal and economic orders over the last 30 years, but very few have succeeded in having development beyond a very narrow band of the population. And the reason for that, according to DeSoto, and I am persuaded by this argument, and evidently so is the Georgian government, is that there was inadequate title security for the many. It's very hard to borrow money without collateral. It's hard to post collateral unless you have a secure registry of especially real property. If you can have a secure registry of real property, then you can borrow on that real property. And if you fail to pay it back, the lender can take that real property from you. It's all part of what has allowed wealth to build so over such a large percentage of the population within what we used to call the first world. And so there's this promise that evidently the Georgians have attached themselves to. I should mention that this was tried, actually, this blockchain for land registries in Honduras, but it stalled. And it stalled for reasons that are unknown to most, unknown to me, but one can imagine that maybe the commitment wasn't there politically that there is in Georgia. Let's turn. You were posing a sequence of blockchain applications, right? And in the middle of that sequence was the settlement of contracts, I think. So there's been a term called smart contracts that's been applied to blockchain, where blockchain might be of great use in making things work a lot more efficiently among contracting parties. Could you comment a little bit about what problems that solves and what the promise is?
Sure. Let me take a couple of steps to get to smart contracts, because I think it's a more advanced use case of the technology. So the first and one of the lowest hanging fruit is the settlement and reconciliation that custodians do in the trading process. And so if you look at trading of equities or of even just simple securities like equities, before even getting to more complex securities like derivatives or other types of contracts, it's a big portion of the investment management industry just to know what was traded, making sure that the firm that placed the trade and made the trade, and then the firm that received the security, that they're talking about the same thing, that the order is the same, and that all the paperwork and everything documenting that the transaction took place is real and is retained according to regulatory standards.
That sounds like a lot of people and a lot of processes.
That is billions and billions of annual revenue that investment banking firms pay and that custodians get to generate as revenue. And so I think a lot of the activity that the large investment firms are working on is around that. And you don't even have to get more complex into sort of artificial intelligence or programmed contracts. It's just that reconciliation. So you can imagine multiple levels of automation essentially coming in and replacing human activity by moving settlement onto the blockchain. There's an initiative called the Utility Settlement Coin that I believe UBS and a number of other banks put forward to the Fed. And it's really interesting because they call it the Utility Settlement Coin. I mean, it's literally don't be scared of this really boring coin. It's just for operations coin. Imagine if you're the Fed or the central bank in any other country and your biggest global financial institutions come to you and say, listen, we're just going to create this digital currency. Don't worry about it. So I'm not surprised that it's called so innocently the Utility Settlement Coin. That's the next couple of years. And I think if we look ahead maybe 5 to 10 years, the key project that jumps out at me is called Ethereum. That's Ethereum.
Lex, can I stop you there and interject something about because you mentioned derivatives, and I think derivatives are the next step after the simpler transactions, that the Commodities Futures Trading Commission is actually entertaining or reviewing the use of blockchain in settling derivatives trades. So it's a way around regulation, but it's also something that the regulators are beginning to take seriously as well when it comes to trading commodities and securities. Okay, but now you're moving to Ethereum, which is another step still.
Yes, and I think those two are connected. So I'll try to jump back to smart contracts because I think these two things are essentially one and the same. So Ethereum is a way for developers, programmers, engineers, whatever you want to call smart people that write computer code, to build applications on top of the blockchain. So the original blockchain, that Bitcoin version, and then all the different permutations coming out of consortiums, very specific and have some properties that make it difficult to build things on top of it. Ethereum is a blockchain that is meant specifically for developers to take advantage of it. And this is pretty powerful. I mean, if you think about the power of the iPhone and the App Store and how the App Store has allowed the iPhone to have functionality far beyond what the core technology is and create competitive moats around it. And so people have started using Ethereum to create different applications. For example, there are kind of trading markets, there are prediction markets that are built on Ethereum, and then smart contracts are built on Ethereum all the time, quite quickly. And the way that a smart contract works and could work with something like a derivative for the CFTC, whether it's built on Ethereum or whether it's built on the blockchain, is essentially like taking a legal document and putting it into code. Imagine if the United States Constitution was 13 lines of code, or a legal contract like a derivatives contract, which has different things that each party needs to do in order for the thing to actually work. If that was written as computer code, and for each part of that computer code, things would need to happen in the real world for it to be activated. And then once they activate, you would actually have the contract itself move forward to whatever the next step is. And so I think we're seeing that play out now. We've seen a real implementation of this on Ethereum called the Decentralized Autonomous Organization, the DAO. I don't know if you've come across it, but this innovation is already happening, and it's out in the world. And it's one of the most alien things that are coming out of blockchain innovation. There are issues that pop up all the time. So, for example, if your computer code is the contract, is it really legal, or is it still technology? And if there is a discrepancy between how something is coded, if let's say there's a bug between the web version and the paper version, which one controls? And who gets to interpret it?
Lex, there are never bugs. I've never experienced a bug in any technology, not even this morning and all day with our computer system here at my office. No, there aren't any bugs. Anyway, please go on.
There's a $70 million bug that I'll tell you about. And the $70 million bug was in the decentralized autonomous organization built on Ethereum. And I think it brings up this broader idea about hacking that I'd love to talk to you about. But what had happened is that Ethereum is just the technology, right? It's the raw Lego pieces out of which you can put something together. So a group of enthusiasts who think this is the coolest thing in the world put together the DAO. They wrote their own code. They used the Lego pieces and they put it together. And the DAO was essentially a venture capital fund. It was a smart contract where investment ideas would come in front of the DAO, and then using the technology, consensus would be reached. So the smart contract in this case is, how do you vote? If enough people vote, then an investment would be made out of the fund. And the fund raised a ton of money, I believe 150 million or so, in digital currency. Within a couple of weeks, I think, a rogue developer, so I don't think we know the identity yet, found an exploit in the DAO code. What they figured out was that if they wanted to withdraw money, they could do so recursively. So they could withdraw some amount of digital currency out of the DAO as if they just wanted to leave. And while it was processing that idea, they could ask to withdraw the same money again and again and again and again. And so they withdrew 70 million equivalent of digital currency out of the DAO and pretty much broke the entire experiment. And so I think that's a very expensive mistake, but it highlights this sort of really difficult environment where there is yet no consumer protection, where it's not clear what is the law and what is code, and generally it's the Wild West.
It sounds a little bit like the Sorcerer's Apprentice, without the sorcerer coming back to put everything right. Well, okay, smart contracts. I guess I was thinking, when it comes to the promise of smart contracts, of insurance contracts, large-scale insurance contracts, where the participating entities, the insured company and the insurance company, and maybe even the insured company's counterparty, if it's a trade credit contract, for example, are putting in inputs, and those inputs might cause certain triggers, so that the arguments that you have over whether adequate notice of this or that condition was there would be prevented. That is, there would be this common uncorruptible basis of information, so that insured and insured could go about their business without worrying about being caught in a gotcha situation or something like that. But that was the discussion 5 minutes ago. Let's talk a little bit more about how this can all go to something in a handbasket. Bitcoin storehouses themselves have been hacked. My understanding is that the block and the chain are put together by cryptological security, which sounds awfully formidable to me. But what are your thoughts about the potential hackery and distributed ledgers, whether they're public or private?
That's a great question, and I think a lot of folks have just general unease about this whole area, and partly that's because of Bitcoin's history, where it was used in many gray markets on the web, whether it was for piracy or for criminal activity. Its anonymous nature was the reason that it got its start. It's grown up after that, but Bitcoin has gotten this reputation for illicit activity, and then it's also been very, very volatile. And so those reputational issues by some sort of transitive property have been applied to just the pure mathematics of what the product and what the technology are. But if you look at the actual concept and where the hacking has happened, the hacking focuses mostly on things that are built around the currency or around the blockchain. So it's not the actual mathematical approach of creating the hash or encrypting information or how the Merkle tree is put together out of the different blocks. Instead, it's the services that people are building around it. So for example, it's very hard to carry Bitcoin around. You need to install a whole bunch of software on your computer if you want to do that. And most people use what's called a Bitcoin wallet. And Bitcoin wallets are hacked all the time. or alternately people use Bitcoin exchanges to buy them for dollars or for pounds or whatever it is, and exchanges get hacked. So Mt. Gox is the biggest example. So I think the fear there is actually not what's wrong with the underlying technology, but it's who am I transacting through, and I expect to definitely see regulation around those types of companies and making sure that at least some common base is protected. If you look at the actual encryption, I guess in my research, I've seen two ways that come up. Maybe there are more ways to attack and hack Bitcoin or blockchain, but the two ways I've seen is actually figuring out a way to cryptographically break the encryption. And for that, you need just unbelievably large computing power. I don't know the numbers off the top of my head, but it's something like longer than the entire. You would need to try and decrypt something for longer than the entire existence of Earth for you to be able to break through and get the information.
That's hard to do.
It's hard to do unless you have a quantum computer. So once we have quantum computers, the whole game might change, but we have no idea when those will come around. The other way is if you control more than 51% of the entire network. And that's actually what we see a lot of in the small cryptocurrencies. So the general rule is the more participants, the better the network and the stronger it is, and the harder it is to manipulate. But if you're in a position where you own 51% of Bitcoin, it's not really in your interest to sabotage it and then lose all the value because you own so much of the currency or you control so much of the currency. So those are the two outs that I've seen, but I would be much more focused on who is providing services on top of it rather than the technology itself.
Well, Lex, I think this has been a very good introduction to the questions of blockchain, or the questions that blockchain causes to arise in the provision of financial services and a bunch of other things, evidently. We really appreciate you joining with us. We might be asking you back for step 2. Anyway, thanks for being with us, Lex Sokolin of Autonomous Research.
My pleasure. Thanks for having me.
You've been listening to Financial Poise Radio. I am Christopher Cahill. Financial Poise Radio is produced by Stephanie Strait. Really appreciate you listening. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.financialpoise.com. Each week, Financial Poise Radio brings you news and education about finance, investing, business, and law. To see a short written summary of this episode, go to www.financialpoise.com. Financial Poise Radio is a production of Financial Poise Radio Productions, LLC.